There are three symbols that are absolutely getting my attention right now, and we're going to start off with the S&P, but we're going to take a look at the US dollar and the euro because they're kind of the same conversation, and yields, bonds as well. We'll look at bonds through a couple different lenses, all right? So, right, by the way, I haven't done a video using TradingView in some time. I haven't used TradingView for this, and it's always a platform that I have open. It's always a platform that I have on my phone. And I only mention this because they have an unbelievable Black Friday sale. So if you're looking for that backup platform for charting, this is it. And it does allow for you to use all my tools, right? If you have any of my premium tools, VScore and HPMR, DPMR, Propulsion, Wave, Grab. Yeah, these are available also in TradingView. And a lot of folks do ask me, hey, Rog, I'm in a place in the world that I can't or may not be able to keep getting Thinkorswim. This is a fantastic alternative. I use both, right? Being in the US, I have Thinkorswim and I have TradingView. So I just want to mention that here really quickly on the onset of our discussion, okay? All right, so let's get to it. What do we have here in the S&P? First of all, I think the thing that looks really interesting right here, gang, how long has it been since we've had the lower trend? That's the trend section of the multi-trend, the lower. How long has it been since it's been green? It's been a long time. As we are wrapping up November, as we head into December, where strength gets stronger, weakness gets weaker, window dressing, where we have tax loss harvesting, three big phenomena coming up this coming month in December. All right. First of all, tax loss harvesting and window dressing are probably easily going to be nearly month-long phenomena. So if you're curious about that, I'd say the most intense part of each is going to be the last 2 weeks of the month, but you'll really see it throughout the month. The often discussed Santa rally is not a month-long phenomena. It is a very small window that occurs right around Christmas time. So figure Christmas to, I would say, look at the Santa rally to begin around, so if we got to December, right? Look for the Santa rally to begin basically the week of Christmas, so call it the 26th, and end that week, the 29th. It might start a little bit earlier if you look at the session that precedes the Christmas Monday as Friday the 22nd. Maybe it goes Friday to Friday. Santa rally is a very tiny window. It is not a phenomenon that lasts all month. So call it maybe 22nd to 29th this year, right? But we have three different phenomena. Going into December, if something can start to look stronger, it will likely accelerate through December. December can be an accelerant, not only of weakness, but also of strength. This is a big deal, gang. XLF, we've talked about this quite a bit. XLF also number 2 weighted sector in the S&P. XLK number 1 weighted sector in the S&P. This is the S&P firing on 2 cylinders. This is very exciting. This is very bullish. The index being supported by 2 of the most important sectors. So I mentioned S&P, dollar, bonds. Oh my, let's go take a look then at the dollar. Now there's 2 ways you can look at the dollar. Some of you on Thinkorswim are going to say, Rog, I can't pull up DX futures. That's correct. You can do so delayed on TradingView, but I'm going to show you a little hack around that and why that hack is probably more important and better, more accurate. DX futures is a basket of multiple currencies. 58% of that basket is the euro. After that, it's yen. After that, it's pound. But really, it's the euro with fairy dusting of a couple other currencies, of 5 other currencies. So it's a basket. It's not the dollar. It's the dollar versus other currencies. So the dollar versus other currencies, mainly the euro, is crossing down through the 200. This is now in the bearish hemisphere. So for those of you that have been waiting for confirmation that the dovish expectations are landing in places other than an uptrend in the equity markets with the Nas and the S&P, they're landing here. A central bank that is beginning to go dovish, that's favoring a more accommodative monetary policy stance and eventual rate cuts, which is what the doves prefer, right? That's where we're heading, is going to weaken the currency of a country. A dovish central bank weakens the currency of a country. So for all of you that have been waiting for weak dollar, there it is. What's another way of looking at it that's more accessible? If you're on Thinkorswim, pull up the 6E. This is the Euro futures contract. This is 58% of the US dollar basket. If you were to turn the US dollar upside down, you'd get the 6E. Doesn't that look almost the same? Look at the interaction at the 200. Look at the fact that we're above it now. The euro is trying to go into an uptrend, gang. This is about as bearish to the US dollar as we've seen since mid to late July. It's a big deal because macroeconomically, we're accompanying a much more dovish tone from the Federal Reserve about the most dovish Fed fund futures target rate probabilities that we've seen, one if not two rate cuts by the July 31 meeting. And the euro is strong as the dollar is weak in the wake of that. This is a big deal, gang. So if you've been looking for dollar weakness, look for euro strength. If you can't pull up the DX futures, pull up the 6E futures. Okay? All right, what about bonds? Okay, let's talk about yields in a couple different ways. Let's start with the long bond. At least the downtrend is broken. And I hope for those of you that know that, number one, inverted yield curve means nothing. Okay? Higher yields have meant nearly nothing. If you take a look at the trend in the NASDAQ, if you take a look at the trend in the S&P, it's not as if with higher yields that those indices are down. In fact, the NASDAQ is knocking on the door of new highs on the year, right? Let me show you here. Here's an NQ futures. Look at this, gang. We're knocking on the door, if not making new highs on the year. So please, this notion that higher yields kill equities, I don't know how else to emphasize. It's just wrong, right? Like the Fonz. You remember he couldn't say wrong? Yeah, no, it's wrong. The Fonz has to admit it too. This is wrong. Yields moving higher do not undo equities. However, you might say, Rog, yields are moving lower. Okay, and that's what this move to the upside is. Yields in the direction of the bond market are opposite, right? So as bond prices in the ZB or TLT move higher, that's lower yields. So why are they doing that? For the same reason that the US dollar is pulling back. For the same reason that the euro is rallying. We're finally seeing what will be more accommodative monetary policy. We're going to see rate cuts. That's all that means, right? Rate cuts. And so the yields have to go lower in response to what's coming from the Federal Reserve. So there you go. We have a long way to go before the bonds are in the bullish hemisphere. That's above those white dots. That's the 200 exponential. But before we go into an uptrend, we've got to break the downtrend. We've got to find a range, and then we can go green. 2 out of 3 things have happened. We've broken the downtrend. We're finding a range. Next step, can we get into an uptrend and above the 200? Now, this is the ZN. This is the 10-year note. I know a lot of folks like to look at this through the TNX. TNX is actually the yield. This is the futures contract. See how they look like a mirror image of each other? So yields are coming down as the ZN is going higher. And this is going to reflect what we're seeing in the long bond as well. All right, what else can we look at? Well, if yields are coming down, one interesting way to look at it is through the prism of higher risk appetite. There's 2 ways to look at higher risk appetite and yields together. Because I could look at higher risk appetite by looking at tech, right? XLK, XLC. Typically, risk appetite is going to land in tech, XLC, XLY. There's another place we can look at, and that's junk and high corporate yield. So this is a combination of looking at yields, but also looking at a certain amount of aggression, right? The idea here is if high corporate yield is appealing, risk appetite plus yields, if high corporate yield, if junk bonds are appealing, then that tells me that people have an appetite for risk. You don't have an appetite for risk, you do not have that if we don't have an overall expectation for the equity markets to climb, right? And you certainly don't have that when people are looking for cover. What would that look like? Looking for cover looks like the continued downtrend in bonds or appeal in XLP, XLU, XLRE, those defensive corners of the market that have dividends, right? If my stock isn't going to climb, at least I want to get paid by those dividends, right? Those three, XLE to a certain degree has high dividend yielding names too, but it's more tethered to crude. But dividends become more appealing when we don't expect our stock price to climb. That's not what we're seeing here. Look at XLP, right? Look at XLU. Being below the 200 in the bearish hemisphere, that's actually pretty good. We want to see that because if the NASDAQ and the S&P are going to continue higher with XLK and XLF, I just assume the defensive not really be appealing to anybody. I don't want to see broader participation in defensive names as traders are looking for cover. I hope that makes sense. So we can confirm ideas across multiple symbols, right? So we already looked at the uptrend in the indices, S&P and NAS. We looked at the downtrend being broken in the euro or the uptrend being broken in the dollar, right? And then we can also see that treasury yields are going down and there's more appetite for the riskier version of yield, right? Which is HYG and JNK. All that has to work together. One of these alone doesn't do it, right? They all have to work together. So is it about leading and lagging? Of course not. It's about, are they working in harmony and unison? But we can make words up too. So that's what we're looking at here, gang. And I hope that makes sense. That's how we can manage our expectations as we wind up this year. And I expect it's going to continue to be pretty darn bullish. And I'm super, super optimistic based on all this for 2024.